So I'm going to talk a little bit about where we are with the economy as of August moving forward here. And we're going to start off with retail sales. You got to understand that it's really the consumer that drives the US economy. And what this chart is showing, it's showing the retail sales seasonally adjusted by month, going all the way back to 2000 and up to where we are in 2021, halfway through the year. You can see on the right side of the chart, the dark blue line, the severe drop, and that was when COVID hit in March of 2020, starting actually the end of February, and that huge drop in sales. But look how fast the recovery took place, especially when you compare that recovery time, that thin shaded line compared to the recession in 2008 and 2009, how wide that shaded area was for the drop in sales and how long it took to recover. We've seen a huge, rapid recovery in retail sales, which is a good sign, which is what pulled us out of a supposed or potentially long-term recession that could have been starting then. But let's go a little deeper into what actually took place inside of those sales, because there's two components to this. There's goods and services. I'm sure you guys have heard of that. And when we break it down of where the sales were happening, the chart on your left is talking strictly the rebound in goods, in the sales of goods. What are goods? Those are things like computers, lumber, pens, paper, any hard physical thing you can buy is represented in goods. On the right side is sales of services, and services is what took the big hit and still hasn't fully recovered. Those are things like going to the barber. They provide a service. You're not buying something from them, a hard physical asset or something you can consume. They're cutting your hair. Waitresses, those are services. Things like that. The service industry took a huge hit, and that has not fully recovered. So you can see the disparity here in goods and services, which are measured basically in retail sales, but it's not consistent throughout the whole industry. Next is the $2.5 trillion that we have sitting in savings. This is an amazing, amazing figure when you look historically, which this chart only goes back to February, which is basically when the COVID started and what had happened to personal savings. We've seen a huge growth in the supply and the money supply of people in their individual bank accounts, investments, and things like that. You couldn't go out and spend the money. A lot of companies were allowing people to work from home or do some type of work from home and keep earning a paycheck. So that kind of bolstered what went on with savings. So we've got this huge, unprecedented amount of money that people were able to build up in their savings over the last year, and it is still there. So when we're looking at consumers being able to spend, this is a huge sign that there's still a lot of ability for people to go out and buy things moving forward, which is a positive for the economy.
Well, and it's interesting, Rocky, because one of the things you said in the beginning was the consumer is driving the economy here.
Right.
And this just kind of amplifies why things aren't as bad as we might have thought they were going to be.
Correct. Now, let's talk a little bit about hiring. When we go back to the September of last year, about a year ago, we did see some strong initial recovery in hiring coming out of the COVID pandemic, as slowly businesses were able to start operating at a limited capacity. And obviously the essential businesses were fully functioning. So you saw in September of 2020, the non-farm payrolls on a monthly adjusted were at about 716,000 increase in labor. It kind of tailed off going into the end of the year, as you can see in this chart, picked up a little bit in the first quarter. We had a 785,000 increase in payrolls in March, but then it kind of dropped off. However, recently, June and July, back to very, very strong signs of hiring, and we believe that's going to continue. But we believe that we're going to continue to see strong recovery in jobs growth. Now, this chart measures exactly what's going on with the demand and the supply of labor. So the black line represents job openings and the blue line represents unemployment. And what you see going on from about the beginning of May into where we're at now, the actual number of job openings has increased and gone over the number of unemployed. So we actually have about 1.1 job openings to actual people looking for a job. So the demand for labor looks like it's going to continue to be very strong. People that want to work or are looking for work should be able to find a job, which is also very strong for the economic recovery.
You know, Rocky, just a side note there. When you think about the unemployment in December of 2020, our unemployment rate was at 3.5%.
Right.
As of July, with those numbers that Rocky was showing on the previous slide, we're sitting right now at 5.4%. So still a long way to go to get everybody back to work where they were prior to this whole pandemic thing going on.
Yeah. Well, another thing we want to look at is what's going on with wages. As people are going back to work, what kind of pay are they getting for re-entering the workforce? And you can see here from 2001 into the Great Recession of 2008, 2009, actually the year-over-year earnings was on a decline. But since then, the payroll increases have been on about a 4% growth rate. And you can see that we're heading back towards that moving into 2020 and 2021. So good signs that not only are people getting able to find work, the pay for them is on the increase, and that's a good sign. So consumption, again, it's all around the consumer, how the economic growth takes place in the US. When we're looking at consumption, we saw about 7.8% growth rate in consumption for the second quarter of this year, and we expect that to stay strong. However, we do have some issues that are creating problems for us, and I will talk about what that is in a second. But what this chart is showing is when we look at the blue line, this is retail inventories. And retail measuring inventories tells us basically how well consumers, when they want something, can go get it because there's a certain amount of inventory that's available. Look at the drop that's taken place since April of 2020 through April of 2021. Inventory levels are at all-time lows. Now let's compare that to the black line, which is the number of containers that are coming in on a monthly basis into the Los Angeles harbor. That's bringing goods into the country. We have seen an extreme uptick in the amount of shipments coming in. However, we're not able to still meet the demand because the inventories are not growing. So that's what this is representing. Even though we are trying and we have increased the supply chain, we are not able to keep the inventory levels up to meet all the demand that is out there. And one of the reasons that this is happening is, you know, as we know in the automotive industry, since we're an automotive town, we know that there's a lack of semiconductor chips to put in vehicles. And as long as there's these supply constraints out there, inventories are going to remain low. And not only does it affect autos, but think of it. Today, you even have washers and dryers that have computer chips in it to run the digital panels that control your washer and dryer. You've got cell phones, you've got computers, all those things that require chips are having issues with getting supply, which minimizes the amount of production that can take place. So we're not able to build inventories in a lot of areas right now moving forward. So that's going to take a while to work its way through the system. and that will hinder the consumption rates moving forward, but we still believe they will remain strong because of pent-up demand, because of what we showed you before, the amount of savings. People have money to spend if goods and services are available moving forward. A lot of these things we've been talking about actually have a negative impact on inflation. They're inflationary. When supply is low and demand is high, that means that you have to pay more for those goods and services. So we are seeing inflation. But what we're trying to show here is what is actually happening to the core inflation rate since 2000 through the pandemic of 2020 and now where we're at. And you see that black line, the huge jump here in 21, where core inflation has really spiked and jumped up from an average of about 1.5% to 2%. We're up over 3.5% to 4%. But when you remove some of those supply constraint components, such as automobiles, computers, things like that, the core inflation rate without those outliers represented by the blue line is kind of staying relatively in place. And this is why you're hearing, while we're talking about inflation is here, people and the economists are believing it's short term, because as those supply disruptions improve into next year, we believe the core inflation rate will come back down to these more normalized levels. However, in the short term, we're seeing it, and it's pretty significant. When we look at gross domestic product, we have actually recovered back at the end of the first quarter of this year to the pre-pandemic levels. And we are continuing to see rapid growth in the overall gross domestic product growth rates over this year and next year. We believe it's going to be above the historical averages. And that dotted line is kind of representing where we were pre-COVID. And as you can see, the actual numbers are above it now moving forward. These are all good signs, however, also temporary inflationary signs too, moving forward. So when we look at corporate earnings, where are we at relative to previous recessions and recoveries? When you look at the black line on the bottom here going across, it took about 289 days for the recovery in 2004 and 2010. And those recovery rates were at about 8.3 to 8.9% of earnings during those periods. When you look at the blue line, the top line, look how fast we recovered from the pandemic as far as corporate earnings. Corporate earnings in 2021 are expected to be about 19.7% growth rate year over year. And we're projecting on that kind of grayish blue line, the 2022 earnings growth rate will be about 11.8%. Not as strong as this year, but still a very, very solid second year recovery, looking at it compared to 2004 and 2010. So earnings outlook, very strong at this point. We believe it will continue into 2022. When we look at corporate net profits, the change from 2020 to 2021, you can see the overall S&P here on the left side of the chart, the black representing 2020 second quarter. Net profits were averaging about 9% for the S&P 500 firms. This year, they're up to about 13%. That's a huge increase over last year. And when we break down the sectors, the financial industry recovering very strong at 21% net profit margin for the second quarter. Industrials, 9% this year versus 2% last year. Information and technology actually is one of the slower growing. However, if you remember coming out of the pandemic, they were the strong suit. They were the companies upholding the pandemic and keeping the market going, keeping consumers going, because they were the ones supplying the goods and services when other companies were shut down. They could continue to operate. So even though they had a strong 2020, you can still see they're very strong this year at 25% net profits in the second quarter of 2021. Consumer discretion more than doubled compared to last year. And energy, which was flat, basically having a fairly strong 6% profitability in the second quarter this year. So overall, we think the S&P, the US businesses are strong, the large businesses are strong, and we believe there's continued opportunity there moving forward.
It is amazing how far we've come with this economy, but I look at a lot of those numbers and well, there's a dichotomy still going on right now, because we have parts of the economy that aren't doing well, and you've got other parts of the economy that are just booming at this point. And it's showing up in the inflation rate, it's showing up in the profits, it's showing up in the markets and the different sectors out there. That's why it's so important. You can't just have a buy hold strategy in the economy and the markets we have today. We really do have to have a targeted approach. As you see the winds, kind of changing out there as to where the profits are going, what sectors are going well and which ones are still lagging.
Right.
And that, I think we're going to see, when you think about the stock market, the accounts, the money managers, I think you're going to see a rotation going on, because the tactical managers, that's what they do, and that's how they really kind of get the returns that they've been getting, so far.
And they know how to overweight, underweight those sectors to give us the returns, to keep those returns on track of what we're trying to accomplish overall for our clients. So,
yeah, and it is interesting, because when you were talking about like supply chain and everything, many of you know that we're looking to build on a piece of property, and I just got a notice this morning from the builder that the garage doors, which seem to be in low inventory right now, are 9 to 12 weeks out just to get the garage doors. So, there's strategic planning that's got to go on for everybody. If you're looking out there buying products, when do you do it? Do you wait, if prices are high in certain areas, or do you go ahead and go full steam if you've got the extra funds to pay for it, which it appears a lot of people do at this point.
Right. And I think that's what's keeping the demand up in the housing market, in the auto markets, things like that. The fact that people have the money, they're willing to pay more right now than normally you would.